Could the U.S. end up with the same credit rating as Slovenia or Bermuda? Alan Braitman joins us from the newsroom to explain. Alan.
All right, Betty. Well, these nations rated riskier borrowers than the United States, which boasts a AAA credit score. But as the U.S. plows trillions of dollars into the financial system, some investors wondering if Uncle Sam's credit rating is on shaky ground. That is the signal, at least, that credit default swaps are sending. The cost, for example, of insuring Treasury bonds against default surged last month to a record. Back in March, the U.S. became a riskier borrower than Germany. First time we'd ever seen that according to these traders of credit default swaps. Now, the IMF has said the U.S. credit rating could be at risk if lawmakers turn Fannie Mae and Freddie Mac, which are operating under conservatorship, if they were turned into fully public companies. Could not come at a worse time for the U.S., which is leaning on creditors such as China and Japan to buy U.S. treasuries and thereby fund the ballooning budget deficit at very low interest rates. Betty, with that, I'm going to send it back to you.
Okay, Ellen, thank you very much. For more on this story, let's bring in John Chambers, chairman of Standard & Poor's Sovereign Ratings Committee. He comes to us from S&P's offices in downtown Manhattan. And John, great to have you with us. You just heard that report from Ellen, the CDS market indicating that U.S. a riskier borrower. So why affirm the rating here? Why are you more optimistic about the outlook for the U.S.?
Well, Standard & Poor's has a stable outlook on our AAA rating for a number of reasons. The dollar is still the key international currency, and that condition is going to remain. It has flexible labor markets, flexible product markets, and although the debt burden is certain to expand quite markedly in the next few years, the United States is still starting position. Its starting position still, I think, gives it a little bit of room to maneuver here.
But does that mean the CDS market has it wrong, or are there some legitimate concerns?
Well, the CDS spreads that I'm looking at still has the United States trading at a AAA. But the debt burden of the United States is going to rise markedly. And I think that some of these spreads that have blown out with all AAAs is showing that. By our figures, the net government debt burden to GDP is going to go from about 44% now up by the 2013 to about 70% of GDP.
And isn't that alarming?
Well, you have to look at the economy overall and what the consequences would be if we didn't have the United States government taking on some of the debt that the private sector is going to be shedding. I'm afraid that the alternative would be a very long and protracted recession.
Okay, then what's the biggest risk right now to the rating?
Well, I think that the biggest risk to this rating or to a number of other AAA ratings that we have right now would be that after we have this fiscal stimulus, you don't have a fiscal consolidation that would take place in the second half of the Obama administration. And we'll be looking for signs of that early on.
In the near term, John, though, what would make you go back and take a look again or review the U.S. ratings?
I think that any indication that we have that our projections of fiscal deficits of 10, 11% for this year and next would continue on for the third and the fourth year of the Obama administration. That would be more concerning to us.
Okay, so that's years down the road, really.
That'd be the third and fourth year of the Obama administration, yes.
Okay. John, also, you've mentioned before that the dollar, the strength of the U.S. dollar is one reason why you've got a stable or you've affirmed the ratings on the U.S. But what if the dollar weakens, as some say may happen, given all this liquidity that we're injecting to the market?
Well, that's one of the advantages of the United States is that we have a flexible currency, and that advantage can't be underestimated. But when I say that the dollar is the key international currency, I'm referring to its position in transactions, its position in international reserves, its position in trade, and that is its position in the capital markets, and that is something that we don't see materially diminishing over time.
And as Alan had talked about, the IMF saying that if the government were to take over some companies like Fannie and Freddie and make them public companies, or we're hearing talks about nationalization of banks, I mean, how would that affect the credit rating of the U.S.?
Well, I don't think that the IMF said that. First of all, the IMF doesn't make opinions on credit, but that quotation from the IMF needs to be checked. But right now, both Fannie and Freddie are essentially public enterprises. You have to look not only at the debt and the guarantees that they have, but also on their assets. I don't think that the government's actions in September to basically nationalize those two institutions materially changes the facts on the ground. They had always operated under an implicit guarantee.
Okay, John, and of course, I believe it was in those recent comments from the IMF, but we'll check on that, of course. But John, thank you so much for joining us. John Chambers, Chairman of Standard & Poor's Sovereign Credit Rating.